Hello, everyone. Welcome to our new guest AMA session. We have a very special guest today, Morgen Rochard. She started her career in finance, trading for Trinity Derivatives Group as an equity options market maker. She managed portfolios at UBS Financial Services for high net worth investors. She also worked at Merrill Lynch, providing financial analysis for large private wealth teams. Currently, she runs two podcasts, Money Owners Podcast and Bitcoin for Advisors Podcast. And it's related to money mindset and Bitcoin. So Morgen, thanks for saying yes to us. Thanks for joining us today.
Thanks for having me on. I also currently have a financial planning practice that's 9 years old and a financial consulting practice that's 5 years old. You're welcome to check those out. It's originwa.com and moneyowners.com.
Awesome. So related to that, you must be serving high net worth individuals and clients a lot. What is their current investment thesis when it comes to Bitcoin? What is their psychology right now? How are they looking at Bitcoin in general, and has it changed after what we've seen last year?
Yeah, so the thesis for Bitcoin, regardless of how much money you have, is the same. I think that that's the most common misconception that people have, is that high net worth individuals and investors need some sort of other reason to go buy Bitcoin other than it's money. And I think whenever we break it down to what is money and why people would want to hold money, then which is a difficult conversation to have given the backdrop that we currently live in, right? Right now, we live in an environment where we don't typically think of money as something that we hold for a long period of time. In fact, by design, we're not supposed to hold our money for a period of time. So it's a huge change in somebody's brain to think about why you would want to hold money and why you would specifically want to hold something like Bitcoin, which is a decentralized money that no state can control. So the thesis, though, is the same whether you have $100 million or you have $100,000, right? Because people want to hold money because there is uncertainty in the future, and they want to manage that uncertainty by holding money. And there are ways to hold money, right? If you have some sort of short-term uncertainty that you want to hedge, then the best thing to do would be to hold something like fiat currencies. And we hold them, right, because even though they're being devalued on a regular basis, and we know that if we know we have an expense coming up in the next, 3 to 6 months or 1 to 3 years, then we want to hold something like fiat despite it being debased constantly, because we want to make sure that we have enough money to cover that expense. And that's why typically people have their emergency funds in fiat, right? Because we don't know what the uncertainties or what uncertainties will unfold in the future. And therefore, we want to make sure that if we lose our job or we get into an accident or our spouse loses their job or our kids need something more than usual, right? Like there's a healthcare event or our parents need something, right? You want to be able to cover that. And in order to do that, you keep fiat reserve around, but you know that fiat reserve isn't going to be there for you in, let's say, 10 years when an uncertainty comes up, simply by the fact that even under best of circumstances, the government says that your money will lose value by 1 to 3% per year. And so if you were to do that, right, obviously in 10 years, you'd have significantly less if you wanted to keep that reserve around as quote unquote long-term savings. We don't have long-term savings. What we have now is investment. And so there's a shift now that's going on, whether you're high net worth or not, that is basically where people are starting to understand that you actually want to own a long-term money. And that is exactly what Bitcoin is.
Very interesting, which to me leads to the second question. So you've been referencing Bitcoin as a store of value, right, over time. So what would be, in your opinion, the next wave of adoption in regards to the properties of money, whether it's like medium of exchange or if it's unit of account? Would you say one of those two is first to come?
As far as adoption is concerned, I mean, I think that
Yes.
those things are already happening. And well, I think from an adoption standpoint, to just answer your adoption question, then we can go into the other aspects of money. From an adoption standpoint, we do things in herds. That's kind of how human nature is in general, right? We want confirmation from other people around us that what we're doing is correct. And so when we see people herding into Bitcoin, it's because they see others around them going into it, right? And we tend to do this in waves. So adoption in general tends to happen in waves. And I also think it is related to how people understand why they would want to hold money. So if you ask somebody 10 years ago whether or not they wanted to hold Bitcoin, right, it looked very different than it does today because there's so many more people involved. There's so many more software engineers involved at this point. There's so many more companies involved. The infrastructure around it is very different now than it was 10 years ago. 10 years ago, it was just sort of this silly libertarian money that people, some libertarians were interested in, right? Whereas now that's not necessarily the case. Now people are seeing that, yeah, it's actually really, really important to hold a money and to have that money be a differentiation between the money that we currently have. And I would say even more so for people is just recognizing, given the current macro environment, what's going on. So I think that is actually what leads to the next wave of adoption, is really more so what is going on in people's governments rather than, what specifically happens in Bitcoin. So for me, right, like what I've been seeing is that inflation has been rampant in the US, and rampant for us is, 8% is pretty high for the US. It's what the government is stating is inflation. So inflation is likely much higher than that actual 8%. Inflation is a very individual rate. And so some people might be experiencing 8% and some people might be experiencing 30%, given, what basket of goods and services it is that they're consuming. And so when you're experiencing something like 30% inflation, right, it's very easy to see why you wouldn't want to have the government be involved in your money and why you would want to hold something different. Even if you don't necessarily want to be 100% in Bitcoin or something like that, right, you could see why you would want to have a decentralized currency like Bitcoin that can act as a store of value. And then it can also act as medium of exchange and unit of account. I think unit of account actually plays in very nicely with what's going on right now. So an example that I like to use about this is actually in regards to rulers. So imagine you're building a house, and I think both of you probably use the metric system. So forgive me if I'm a little off, but so you have, a 1 meter ruler, basically, a 1 meter stick. And if the government decided, let's say, that 1 meter wasn't going to be 100 centimeters anymore, what if the government decided that it was going to be 115 centimeters, right? So for people who already built their houses, that's no big deal, right? They already have used their unit of account of 100 centimeters, not a big deal. For people going to build in the future, also not a big deal. They adjust their rulers, they make the changes that they have to make. It might be a little bit expensive depending on how soon the project is going to happen, but it's also not as big of a deal. For the people in the middle, though, who are halfway between building, which is most of us at any given time in our lives, when you think about what's going on with money, it's completely disruptive and would, lead to errors happening in the building of your home. And so I like to use this as an example because that's what's going on with money. We think we have fiat currencies as a unit of account, but we actually have no idea what the unit of account is, right? Because we don't know how many, dollars or what other currency is going to be printed at any given period of time. We don't know if they're going to print more. We don't know if, the ruler board is going to come back in and say, 115 centimeters was too much. We have to, contract down to 80 to get us back to that 100, right? And so that would also be problematic, right? If you went from 115 to 80, all of a sudden now, if you're in the middle of building this house, it'd be a very unfortunate accident, right? And it keeps going on and on and on. And people make business decisions, investment decisions, personal life decisions based on what money they have and what they expect money to persist in being. So it's very problematic when the government comes in and does things like this, because people can't actually make proper decisions based on what they think their money is going to be valued at. And it's specifically bad in terms of investment, right? Because when money is very loose and monetary policy is very loose and interest rates are very low, people make investments above and beyond their risk tolerance because so much money is sloshing around in the system that they really wouldn't otherwise ever make. And then when money tightens, right, people start to just say, oh, I'm just going to put it in a bank account, which is also not necessarily the right thing to do either. So unit of account actually is not often cited as something that Bitcoin is useful for right now. But I think if anything, it's most useful right now because we know exactly what the unit of account is for Bitcoin. And that's not going to change. And people have tried to change it and they've been unsuccessful in doing so. And then your last point about medium of exchange, I would say that what we use our dollars for. So people like to take their dollars and they like to spend them as quickly as possible. That's kind of how our economy works in general, and how we think about money is like, how can we pay for things? We don't think about unit of account, and we don't think about store of value. And the most important thing about medium of exchange is actually whether or not something is a good store of value. So for instance, if I wanted to buy something from you and I said, I'm going to give you some Morgan bucks, right? Like, you're not going to take Morgan bucks because Morgan bucks aren't worth anything, right? There's no store of value in Morgan bucks. Nobody wants Morgan bucks. I don't even want them, which is why I'm giving them to you, right? And so I would say that like the store of value portion of medium of exchange is really important. And so the counter argument to that is, well, what if somebody spends that money immediately? And the question there is, okay, well, that's fine if they're going to go spend it immediately after they accept it, but the next person then has to be willing to accept it and hold it for a period of time. And most people, when they accept payment for something or they earn money, they're not immediately going and spending that money. There's usually a period of time in which they have to hold that money, even if it's for 3 hours before they go and spend it, where it has to hold its value long enough for them to be able to spend it on something else. So medium of exchange does tie in really nicely, I think, with store of value. And therefore, if you're going to have something that is a good medium of exchange, it has to first start as a good store of value. And that's definitely where we are at Bitcoin.
Wow, that's the first time I'm hearing it in this sequence, because this is a debate that goes on all the time, right? If it is a store of value, why would people want to spend it? But if it isn't a store of value, is what you're saying, why would people want to accept it in the first place? And so
Yep.
that's a great way to put it. So this is the fungible part of Bitcoin that we have talked about, which is, it be in my Bitcoin or your Bitcoin, it's fungible, it's the same. Recently, we've heard about non-fungible version of Bitcoins, which is the Ordinals and the hype around it, and the whole stacks smart contract protocols. I want to know what your opinion about this whole movement and having non-fungible Satoshis. Is it here to stay, or what's your opinion on that?
So stacks and stacks has been around for quite a long period of time. I imagine they're around to stay. They don't have any solutions for problems that I'm currently facing. So I don't see it as something that would be useful to me or to my clients and to generally a broad base of people. I feel the same way about ordinals. I don't know what problems ordinals fix for me. They don't fix really anything, and having something be less liquid in client portfolios generally works out worse for them. And if people want to use, let's say, this asset class as a hedge against everything that's going on in the current macro environment, and they want to have long-term savings, then you still want to have liquidity in your long-term savings, even if you're going to hold it for a long period of time. And so the problem I see with ordinals is that I don't foresee there being liquidity in that. And we've seen that already with NFTs that have gone on Ethereum, is that there is very low liquidity, right? Because they're by design non-fungible tokens, right? There's not supposed to be a lot of liquidity. And so therefore, it doesn't necessarily solve any problems or doesn't provide any solutions to anything that I see facing either myself or my clients. I'm generally pretty happy with the current risk profile of our portfolios. And I don't feel like I need to take additional risk or hedge in any way. And so, yeah, I think it's more about managing the position size of Bitcoin rather than introducing these other aspects that have gone on chain as basically the solution to what clients are seeking.
That's a very interesting way to put it, the problem and the solution aspect, because Ordinals seems to just have been like a very short-term spike, let's say, in transaction and in the mempool. And we saw that we actually released a blog post about it where we cover it, and we see that the increase of the transaction in the mempool just increased a bit during mid-February, but then return to normal, just highlighting the fact that there might not be that many people willing to use it, or actually use it because it's solving actually a problem, because there's no problem to solve in this place, right? Or no solution to provide to any problem.
Yeah, for sure. We've seen this go on over time. So, I mean, I don't know how far back you've been in the ecosystem, but there was in 2013 there was this thing called CryptoKitties. It was basically the original NFT, right? So, I mean, they come and go. They've got different names all the time. They started as CryptoKitties. They were probably something else in between CryptoKitties and NFTs. And then now they're Ordinals, right? I mean, we can rename them as much as we want, but at the end of the day, right, like some people might get interested in that, and most people will not. And so when I'm thinking about what my clients want and need and what I personally need, I'm thinking about something that is going to be persistent and last for a very long period of time and provide a reasonable rate of return. I'm not looking for the next best app that, we can short-term trade in and out of. I'm not looking for, some solution that might solve 0.0015% of the population's problems, right? There are some people that are always going to want something. It's why there's so many apps that exist in the world right now, because there's always somebody who might want something, but it doesn't necessarily mean that it's a blockbuster app that everybody's going to buy and use. And so that's how I see ordinals and stacks and everything else that continually, I mean, you can look back on time. There's so many coins that have come and gone. A lot of them still exist, right? They don't seem to go to zero, but it doesn't necessarily mean that they have any value.
Makes sense. Moving on to this aspect of Bitcoin and what we can do on top of Bitcoin and the fact that it's money. So let's look at how we can generate yield on Bitcoin and if it's something that is actually relevant or that we are willing to chase after. Are we only willing to allocate money or have an allocation to Bitcoin because Bitcoin is money? Or are we also looking into Bitcoin as a way to generate yield with it?
Yeah, so generally, I think that we should start it with what yield is. I think that people don't really understand that to begin with. So when you take your fiat money and you put it into a savings bank, what they're doing in order to give you a yield, which right now, is 3.5% or 4%, whatever it is that they then take your money and they lend it out, 5, 10, 15, 20 times, depending on what the regulations are. So for every dollar that you put in there, they maybe generate $20 worth of loans. They charge the customer a fee, right, or an interest rate on that loan, and then they give you less than they charge, and they make the spread in the middle. And that's known as fractional reserve banking, and it generates quote unquote yield. When you hold fiat currencies, right, you need yield because you're being debased. So if you're putting your money into, a savings bank and you are getting 3% on it, then you are, right now you're not keeping up with inflation, and these accounts never keep up with inflation, but you're at least doing something to make sure that your money is not consistently losing value. It's only sort of losing value, right, when you put it in a savings bank. And when you're putting it in a savings bank, generally what people are doing, unless they are, they're super risk averse and they don't want to do anything other than hold cash, is they're just saying, okay, this is my short-term emergency reserve. I know it's going to lose value, but at least I don't have to replenish it as much as I would have if I had just kept it in, cash in my mattress or in a checking account. And so therefore, right, you're able to use that account to your advantage, even though, and there are also regulations and limits on how much a bank can basically lose as far as money, at least in the US, right? There's FDIC insurance, there's SIPC insurance. Not that you want to go through that route, but if you were to store up to $250,000 worth of cash in the United States, yeah, you'd eventually get that cash back after, going through the government should that bank fail. Obviously that's not what people want in the grand scheme of things, but there's a lot less risk, and therefore, right, that's why people are losing money basically when they put money in their savings accounts. But there is a lot of risk on the fractional reserve side, and we have seen that occur over the last year. I mean, Celsius comes to mind, Voyager comes to mind, BlockFi comes to mind. The other big, FTX, right? You can just name them, right? If they're doing this fractional reserve style banking with crypto, quote unquote, and they are using that in order to, they basically take customer deposits and they're lending them out, and they don't actually have the money there, and they're making loans that are risky, and people aren't repaying those loans, or they're outright stealing customer money, which is another thing that can happen. And a bank could do that too, right? There's no difference between FTX doing that and a bank could also do that. Granted, there's a lot more regulations and there's a lot more things in place to prosecute that bank. But it seems like we're headed in that direction anyways with these exchanges. And so I think that people are not conscious of the risk that they're taking when they say that they want to get yield from a fractional reserve standpoint. So what's come up is other ways to get yield in crypto, right? So the next way to get yield is that you basically are debased by holding a currency. So an ICO happens and a coin is issued and people buy that coin and then they stake that coin in some way or another. And then what the centralized issuer, because that's what they are, they're a centralized issuer, is doing is they're printing more of that coin to give to coin holders in the form of yield. And so that doesn't mean that you're making yield, right? It means that you are basically accruing more of a currency that is being devalued over time, and therefore is less likely to be a store of value, basically, and is less likely to actually accrue any value if it's continually being debased. So that's the second way. The third way is that you get this coin, and then instead of them debasing you through that coin, they just decide to airdrop a different coin onto you, which again may or may not have any value, may not be worth something in the future, may not have any limits on how much of that coin that they can print. And now you own two currencies, which anyone who's ever lived in two jurisdictions knows how annoying that could be in general anyways. So these are generally the three ways that people get yield. When I'm looking at Bitcoin, I don't know. I mean, the other two don't apply, obviously, because I'm not going to store my Bitcoin somewhere and get airdrop something, something else. But the fractional reserve part of it has been happening, and we saw it happen all through last year and in 2021. And there were lots of problems with it. And therefore, the risk that you have to take to get that incremental yield is just not worth it, right? It's not worth risking this asset that is acting as long-term savings in order to receive 5, 6, 7%, in my mind. And so it goes back to kind of what I was saying in the last question, that, I'm very happy with the current risk profile of my portfolio, my clients' portfolios, and we don't need to take additional risk, which would be basically blending our Bitcoin out. And so that's how I see it today. That maybe that might change in the future if we were in a situation where we can lend 1-for-1, and adoption in Bitcoin had slowed. But as of right now, holding this as a growth currency, I just don't see any reason to take that additional risk.
That's very interesting that you're sharing this side of the story, because in my opinion, there's actually a fourth way that we can generate yield through, let's say, what they call real yield or revenue, right? So those platforms generate revenue because there's transaction fees that are happening. We can argue it's basically based on pure speculation, but there's still, revenue that is being generated by those platforms, and then they distribute part of that to the token holders. But from what you're explaining, the risk to reward is not there for, let's say, incremental yield, which might be, I don't know, 4%, 5%, 6%, compared to just holding money, which is a good store of value and will ultimately provide perhaps increased saving in the future if you still hold it for long periods of time.
Yeah. So, but what you're describing is investing in a business. If there's revenue from generating transaction fees, that's not generating passive yield. That's a person deciding that they're going to take their Bitcoin and invest in a business that generates transaction fees. And they could describe it as yield. I mean, we can talk about the semantics of it. But at the end of the day, right, what they get distributed is based on revenue minus expenses, and
Correct.
then is attributed to the portion of the business that they own. And so people can make a decision about whether or not they want to invest their Bitcoin in something that is a business. And again, I think that the risk reward profile is not there yet for why you would want to do that. But I think that that's very different than sitting there and taking passive yield on your Bitcoin.
Correct. Yes. Agreed.
And so I know you wanted to bring this up about Lightning earning routing fees. I mean, that's basically, that's how I would describe earning channel leasing fees and routing fees. It's a business. It's not earning passive income. I would equate it more to like you rent a house. If you go and buy a house and you rent it out, people like to call that passive income because they don't have to, physically be there maybe all the time. But when the toilet breaks, they do, and it's not passive income, right? They have to manage a tenant. They have to get a property manager to do those things, and they have to pay that property manager. So there's top line revenue in the form of rent, right? And then there's a bunch of expenses that happen in the form of mortgage, any repairs that come up, tenant breaks something, you have to replace it. Tenant puts a hole in the wall, you have to do something about that, right? There's vacancy costs. There's all sorts of things that go into running a rental business, and it's not passive income despite what people say. And so I would equate, I mean, the two they're kind of far apart, right? Because like the amount of money that people are earning on Lightning routing fees is very different than, like the giant real estate mogul business that as we see it today. That doesn't necessarily mean that it won't become something like that. And again, it's not passive. It is a business. And so I see routing fees as, it's a service fee basically for providing liquidity. And you're not earning interest on your Bitcoin when you route payments.
Makes sense. Morgan, I wanted to get your opinion on one of the latest regulatory updates that I just read. I'm going to read the regulation announcement, and then I want your opinion on it. So on Feb 15th, which is just about a few days ago, SEC announced a proposal to amend the existing rules for RIAs, the registered investment advisors, in terms of customer asset managed by RIAs. So the Congress gave SEC the authority to expand advisors' custody rule to apply to all assets and not just funds or securities. So it applies to BTC as well. So basically, they want the custodian to be a qualified custodian, and the RIAs themselves should not have the custody of the customer assets. And maybe you can correct me if that's not true. So what do you think about this proposal, and how does it?
Yeah, so it's not very different than what they do now. Right now, if you're a registered investment advisor like me, you have to segregate assets for clients. You use a custodian. So for a lot of people, that's a place like TD Ameritrade, Schwab, or Fidelity. There are obviously others out there, but those are the three big names. We custody at TD Ameritrade, for instance. What it means is that we help clients open up an account over at TD Ameritrade, and they deposit funds into that account. And we have a limited power of attorney over that account to be able to trade those assets, and also to be able to deduct fees if the client says that that's okay and that's where they want to pay a fee to us. But with the exception of those things, we're not allowed to take any of that money for ourselves. We're not allowed to move positions out of that client's account into an account that would be for me. Anything that we do where we move positions or money, the client has to sign something. Anything that is same name, we can do, because we can move it from, one account that's in their name to another account that's in their name. And obviously we would do that with permission. But if the client wants to, let's say, send a wire to Coinbase because they want to go buy Bitcoin, right? They're going to have to sign wiring instructions, and there's going to be a callback that takes place. There's a lot of measures that are, and basically there are rules in place to protect clients so that money doesn't go to the wrong place. And these rules are things that people should do whether or not there's regulation, right? Me as an advisor, I'm a fiduciary, which means that I take the utmost care of my clients' funds, and I put their interests first before mine. And so I don't want to send a client's money to the wrong place, right? That would be horrible for my business. That would be horrible for a client. That's just never something that we want to do. So these implementations of having clients basically wire instructions or signing ACH instructions, and making sure that we're confirming these things and confirming the amount and confirming exactly where things are going, is what we're supposed to be doing. And so having a regulation in place that tells us to do those things is great for advisors maybe who wouldn't otherwise do those things, but for everybody else who is going to do them anyways, it's kind of irrelevant to their business. I would say that the same thing applies to, let's say, to holding Bitcoin, or, I know advisors out there doing other coins. So it's similar to real estate in this regard, right? I don't have custody of somebody's house just because I help advise on that house, right? They're the title owner. They live in that house, right? I can't just one day say, oh, well, you know what? I provided a bunch of financial planning on your home, so I own that now. I'm going to just, cross your name out on the deed and put my name in there, right? It'd be very difficult to do so. It's the same thing with Bitcoin, right? If my clients hold their own Bitcoin in hardware wallets in their home, right? I can't just say, oh, well, these Bitcoin are mine now. I don't have custody over their assets. If a client is holding Bitcoin the way that they're supposed to be holding Bitcoin, which is they're holding their own keys, they're not holding it on an exchange, they're not holding it in any other place, then client has custody, advisor doesn't have custody, and this new rule really doesn't apply. And so the issue is in the middle, when clients decide that they're going to hold it on a platform and advisors have access to that money for one reason or another, in which case the same rules that we were talking about in regards to wire transfers, ACH movements, everything else would also apply to Bitcoin, in which case a client would have to sign paperwork in order to move any Bitcoin from one place to another. And so I think that, again, that's a good protocol that advisors should be doing anyways. And it should not have to even be regulated for advisors to be doing the right thing on behalf of their clients. And so that's basically my take on the rule. I don't really think that it changes very much for anyone who's helping clients do self-custody. I think it's, I think that it does, though, reinforce that advisors should be forcing self-custody. And then on the other side of it is that if we do actually have custody of client assets, so if you're a trustee, let's say, on behalf of a client, that means that you do actually have custody. There's a lot of rules about what custody means and what has to occur. In the United States, at the very least, you get surprise audits once a year, and they're very expensive. If you're a trustee, and basically you have to produce records and show that you've taken the utmost care of a client's funds. And so again, I think that should apply, right? If an advisor is acting as a trustee on behalf of somebody's Bitcoin, then yeah, you should have to make sure that you're not, just being fast and loose with a client's money, right? It's really important to take the utmost care of that client's money. And so the same regulations of custody should apply, whether it's Bitcoin or whether it's stocks.
So we can summarize that by saying that regulation again is just playing catch up with regulation, right? They're just playing catch up on what should be done, right? Or on the other hand, it might just be ringing the alarm on the advisors that were not doing so in the first place, right?
Yeah, I would say so. I mean, the other thing to consider is that what happens with these regulations is generally they annoy advisors like me who are doing the right thing, but then they don't find the people who are doing the wrong thing. I mean, that just seems to happen over and over and over again with these regulations. I mean, for instance, like I get a state audit every 5 years in Texas. When they come around, right, it's just annoying. It's disruptive, right? It takes up, at least a month's worth of time where we have to produce records and do all the things that they're asking and jump through hoops and take phone calls with them. And we're not doing anything wrong, but it also then takes them a long time to evaluate all the information that we gave them and make sure that they check all the boxes that they're supposed to check, that we're doing the right thing. And inadvertently, they always find something where they have a question on it. And it doesn't mean that we're doing the wrong thing. It just means that it doesn't necessarily exactly fit in the box that they're going to check, right? And so then we have to talk about why it does fit in the box, and we do that for a while, right? And then these things go on. And in the meantime, it takes my time away from clients, which is what I'm supposed to be doing, what I'm being paid for, right? I'm not being paid to go hang out with a regulator and tell them why their box should be checked. So I think that that's really more of the problem with these regulations when they come down, is that the advisors who are doing the right thing are going to do the right thing regardless. And the advisors who are doing the wrong thing are just going to do the wrong thing. And sometimes they get caught and sometimes they don't, right? But the regulation in the meantime, it mostly annoys people. And I'm sure the Texas State Securities Board is going to listen to this and they're going to get mad, but that's fine.
It's very refreshing, though, to hear that regulations that we're talking about right now are in a way good, and they should be in place. We have a tendency, I've seen most articles have a tendency to immediately start pointing out what are the negative consequences of every single regulations that's coming up through SEC. It's very refreshing to hear that what you're saying is this should be done, we're doing it anyways, and if it comes here, it's just good for the whole ecosystem. So very good to hear that.
Yeah, I mean, I think that what needs to be recognized in the Bitcoin community is that we do live in a world where we have an SEC, right? Best case scenario would be that we don't have an SEC, right? I think that they don't really protect investors. They don't do a good job of making sure that people aren't being invested in scams. They generally find scams after the fact, after people have lost a lot of money. And we've seen this over and over again. This is not just in the crypto world. I mean, this is also in the fiat world, where they take in investors, and investors they see that next shiny thing and they get really excited about the return that they can make investing in something, and it's an outright scam. And this happens time and time again, and the SEC doesn't prevent these scams. What they do is they then prosecute after the fact. The most egregious example of this that I can think of is actually with BlockFi. So they went after BlockFi for selling an unregistered security, which it was. They fined BlockFi, I think it was $100 million. BlockFi used customer deposits to pay that fine. Right? BlockFi didn't have the money. It's not like they're HSBC, where, they got fined for money laundering, basically. And HSBC was able to take a bunch of revenue that they had made and give that to the government, right? It affected shareholders, obviously, when HSBC did that, but they didn't seize customer deposits to pay that fine. So what the SEC did was basically they accelerated the process for BlockFi by doing that. And then they kept that money, right? They didn't return that to investors. They're not now saying, oh, actually, BlockFi didn't have that money and we stole investor deposits. They're keeping that money. What they should be doing, right, is returning that money to customers who lost their money, who thought that they were they were getting yield, right? And they were lending it, not that the government was going to outright take it. So, I mean, like that's just one example of probably many. I mean, that's the most recent one that I can think of where the government has stepped in and really done the wrong thing on behalf of investors, even though they're saying that they're trying to protect investors. And so I think, though, that's kind of the problem with these government agencies, is that when they do come in, right, they have the right idea in mind. They want to protect investors. They want to make sure advisors like me are doing the right things so that investors don't get taken advantage of, but they just go about it in the wrong way. And so that's why, like, people generally step up and say, hey, there's more harm than good that's going to be done with these regulations. That said, though, we do live in a world where the SEC exists, so they have to do something, right? And so I think it's better that they find things to do that are actually worthwhile, right? And, maybe that means including Bitcoin as part of custody rules for RIAs and making sure that RIAs are checking the right boxes and doing the right things in regards to custody. Custody is a big deal, right? Anyone who has custody of Bitcoin can literally just take that Bitcoin and go somewhere with it. And so having some rules and regulations in place around it is it's not necessarily a bad thing. But what it does do on the other side of that is that it gives advisors a platform to actually have custody of these assets, right? And so somebody who's holding Bitcoin, really the ideal way to hold it is through self-custody. And so what needs to occur is better options for self-custody need to come out for clients so that they feel comfortable and confident actually taking custody of their Bitcoin rather than relying on an advisor to do custody on their behalf. And so I see that as really the only part of this rule that is problematic, because then clients can rely more on the advisor to actually hold their Bitcoin when in fact they should be taking custody of it themselves.
Keeping the ownership of the money sovereign, right? You want to keep the ownership sovereign,
Yep,
right?
exactly.
Bitcoin is already sovereign, so you don't want to forfeit this aspect of it.
Absolutely. Yeah. And I would say, I mean, for most people, it's very difficult to take custody because they've never taken custody of anything in their lives, right? I mean, for most people, what do they have, $500 max cash in their house, if that. Most people have bank accounts. They've got investment accounts if they've got money, right? They've got their crypto accounts. They've got their Bitcoin wallets, right? They leave things on exchange. It's why we know there's so many Bitcoin and other currencies really on exchanges right now. It's because people don't want to take custody. And so what I see is the future is finding good ways for people to take custody, but not forcing them to take custody before they're ready. And so, right, if that means that they hold a little bit of Bitcoin on exchange for a while and they're sending transactions around until they can figure out how to do it properly, then that's great, right? That at least introduces somebody, gets their feet wet, gets them excited about doing it. And then when the time is right, they can take custody. But it's problematic, though, in an environment where, depending on where they're leaving their coins, right, it could be potentially dangerous. So if you decided that FTX was your custodian of choice, right, obviously, while you're getting your feet wet and trying to figure out how to do self-custody, you lost all your money. And so this may be an unpopular opinion, but everything that Gary Gensler seems to come out with with as far as the SEC is concerned, it reinforces that people should be taking self-custody. People want Gary Gensler to say, oh, I'm going to approve an ETF and I'm going to approve all these other products and platforms and things for people to hold Bitcoin on exchange. And instead what he's saying, even though he hasn't quite come out and said this, is no, everyone should hold Bitcoin. They should hold it in self-custody. And so Gary Gensler is actually a huge Bitcoin maximalist. And I think people will realize that in the future. I'm sorry, it's a joke, but yeah.
Right. And I mean, the sovereignty over your own money is also a lot of responsibility, like you said, right? You need to understand and then, feel comfortable that you're able to actually custody your own funds, right? Which is something that I think we forgot to do with fiat money, right? Because we don't attach the same value to it because, fiat is just a way. I mean, most of the people that hold fiat, most of us, right? Because of inflation, we tend to just want to not really get rid of it, but spend it as quickly as possible because next year it will have devalued for, I don't know, 10%, 20%, and in hyperinflated countries like 100, 200, 500, right? So fiat is really a way that you don't really pay a lot of attention to its custody because that's something that you really want to spend as quickly as possible. Whereas on the other hand, Bitcoin is something that you want to hold for a long period of time, right? So then there's the whole aspect of responsibility to it.
Yep, for sure.
Well, Morgen, I really want to appreciate your time. Thanks for joining us today. we're glad that someone with the wealth of knowledge of traditional finance and really understands what money is in the Bitcoin space, in the crypto space, and helping us all understand the true adoption of this asset class. So really appreciate your inputs today. Got lots of good insights, and hope to stay connected, and hope you enjoyed this as well.
Yeah, thanks so much for having me on. If people want to find me, you can find me on Twitter. I'm at Morgen with an E Rochard. I have 2 businesses. It's originwa.com as my registered investment advisor. Moneyowners.com is my financial consulting practice. I also wrote a book. It's the Personal Finance Quick Start Guide. You can find it on Amazon. It's not Bitcoin only. I am working on the Bitcoin Personal Finance book at the moment, but for now, if you need some help with your fiat, you can go buy that book. There is a little section on it about Bitcoin in it, but most of it is really just geared to the U.S. investor and how to navigate all the financial planning concerns that somebody may have. And yeah, thanks again for having me on. It was a pleasure, and I hope to talk to you all soon.
Fantastic. Thank you.
Thank you, Morgan.